Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thanks for joining us today. In today's episode, we're going to go through a recap, real brief, concise, but an overview of the first quarter of 2021. If you're like any of us, well, we're exhausted. A lot has happened over the last 3 months. In fact, let's go to the board and take a look at what we just experienced, because what's amazing is through all of this, the markets, the Dow, S&P, and NASDAQ, respectively, at different times over the last quarter, have hit all-time highs. And it's really mind-boggling. But let's see what we also experienced as well, because keep in mind, if you're a market historian like we are here at Blanke Schein Wealth Management, we watch markets minute by minute, 24 hours a day. We're constantly monitoring, but we're also looking at history for perspective. And we all know this, if you've been investing, and most of you have with us for quite some time, markets climb a wall of worry. But the recap of first quarter of this last year is like none other. So let's go through it. US was in a technical recession, number one. Markets still hit an all-time high. That really doesn't happen very often. Matched with a global pandemic, massive protesters. Obviously, we had storming of the U.S. Capitol, transition from a presidential, from one to another. So we had a presidential transition. The 10-year Treasury tantrum literally got up off the mat like Rocky IV and just kept going. And so the 10-year Treasury showing and predicting, as I said before, if you follow me, and follow along, the bond market is the market you want to watch for the health of the U.S. economy. And what the 10-year Treasury told us is that there's growth to come in the U.S. on a go-forward basis. The stock market, the equity market, is a sideshow, right? It's a lot smaller in comparison to the debt market or the fixed income market, if you will. So yields and interest rates matter. And in this case, the 10-year Treasury stole the show over the last quarter, as going from a very, very low to I think 1.7 at one point in time, a little bit higher. So that escape velocity, if you will, on Treasury yields are both positive, because we need yields to rise to show growth is taking hold, policymakers from fiscal and monetary policy, and that is actually working its way into the system. And so that we're growing out of a recession, and the GDP is also showing us that as well. So the 10-year Treasury was the most important story. But we also had real estate hitting all-time highs. And if you're like us in Southern California here, it is less than a 60-day inventory in most cases, and less than a week on the market if it's priced appropriately. So we have all-time highs for markets. Why is this happening? How could this possibly happen when you have a recession, a global pandemic, mass protesting, storming of the Capitol, 10-year Treasury literally taking off, and we have markets hitting highs? Well, the real simple answer is all of the stimulus. Keep in mind this last quarter, the U.S. Treasury just sent out over $600 billion in direct payments to the U.S. consumer. To put that in perspective right now, that's over 11% of our GDP. 11% of our GDP. That's mind-boggling if you think about it. So the consumers are flush with money. How do we know? We look at the M2 money supply, both savings rate in America. Combine that's well over a 16% right now. And we just gave Americans more money to spend. What's going to happen on a go-forward basis as we look into the next 90 days? We could see the largest, fastest growth in the U.S. economy dating back to 1983. We could eclipse that as measured by the GDP because of the fuel in the economy. Obviously, we got a $1.9 trillion spending package that's rolling its way out last year, and now we've got $2 trillion and a $4 trillion total sort of infrastructure / another stimulus CARES Act that's basically working its way into the U.S. economy. So the U.S. consumer is getting back off their feet. There are states that are opening up, the reopening story. I know there's some vaccine sort of hesitation right now because of some of the story in the last 24, 48 hours has showed a pause on one of the drug makers. But right now, markets took that into stride and literally is looking forward and pricing forward markets of earnings. Now, earnings, if you think about it, the next quarter, the next 3 months, what actually is happening? Last year at this time, we shut down March, April, May, June, July. So if you're looking at comps, what Wall Street looks at is comps, quarter over quarter, year over year comparisons of how you're doing. And you better believe it that the comps that we're going to see from corporate America this next quarter too is going to be tremendous. Why? Because we were frozen in time last year, suspended animation. Everyone was at home not knowing how this was going to play out. So as the economic engine of America was shut down, right, forced to shut down, and around the world, the comps for 2021 versus 2022, year over year, or excuse me, 2020, from 21 to 20, year over year, is going to be tremendous, coupled with all the fuel of the fiscal and monetary policy and support, coupled with all of corporate America continuing to grow. You know, keep in mind, just about 18 months ago, the U.S. was an economic engine about to explode. It was overheating. In February of 2020, we literally were seeing low unemployment, if not 50-year lows on unemployment, and the economic engine. So we came into last year with a healthy economy. And now you have a year in review. We've learned a lot. We're saving a lot of lives with the vaccines, and as well as sort of everything what we've learned from science in the last 12 months. So we're smarter about it, and the good news is market sees that. So corporate America is going to take advantage of that. They're going to take advantage of all that $600+ billion in the hands. And then now look at this. In the next 3 to 6 months, we're going to see policymakers pass some infrastructure bill, some form or another. If we go back from, again, we use history as a guide. If we go back to 2009, so under the Obama administration, when they were trying to, or last recession, trying to get us out of the real estate recession, they passed a bill, a stimulus bill, that really had a multi-year built-in infrastructure and spending. And remember, they had to pivot because it really was taking too long to shovel roadie programs to basically start just doing the highways. But in the meantime, the take-home point from there, and this is going to be the same case here, because this administration is using a lot of the same framework as the Obama administration's policy that they put into place in 2009, was that it was multi-year, multi-tier spending. They're doing it for budgetary purposes, but they're also doing it to keep the market going and to keep the economy going over a multiple period of time. So what does that mean? What's the take-home point? Well, in the first year that a bill is usually passed, it's less than 10% that actually gets working its way into the U.S. economy. Well, good news is that we've got a lot of stimulus between now and then. So in year 2, you got about 24-25% hits. Year 3, you get sort of year 2s and 3s of when an infrastructure bill like that would pass, is when the majority of the spending actually takes into account and gets into the U.S. economy, right? It starts working its way in terms of projects, from bids to projects, right? So that's a lot of room to run in the U.S. economy. Could see the best growth we've ever seen in our lifetimes to come. What could stop that? Again, interest rates. We saw that. If interest rates or policymakers make an error, or at the same time, if Washington goes a little too heavy with raising taxes, but the market already suspects that we're going to have taxes to be raised on a go-forward basis. They thought that Trump was temporary in terms of the tax lowering for corporates. They think 27-28% could land for corporate, and that's sort of baked into the market. So even with higher tax rates on corporations can still grow and make money because of efficiencies of technology, so on and so forth. It's the individual tax rate that we have to keep our eye on, because they have to spend for this, they have to actually cover all this spending, and they're probably going to look towards you and me to do it. So we got to stay close to the evolving conversation in Washington and stay close to your advisory team so that we can create some smart solutions to work our way through policies that are yet to come. So thanks for watching today. Again, it's an amazing day that we had first quarter recap of all-time highs on all the markets that we're covering here at Blanke Schein Wealth Management, and you would never have guessed. So keep in mind, markets climb a wall of worry. Also, stay tuned. We have our Wealthier Retirement podcast. We just redid the studio here, and we're working on it right now for you, and that's to come in the second quarter of this year. We're going to have some great stuff rolling out for all of our clients to follow along with Blanke Schein Wealth Management. Thanks again for watching, and share, like, and subscribe with all your friends and family. Take care. Be safe.